All right. Hey, everyone. It's John Newtson again from Pendra Cannon. I'm joined with my partner in crime here, Matt Warder from Seawolf Research. And today we're having a conversation with Cam Curry from Curry Metals and Mining. So the reason for our conversation today is to talk about gold, and specifically gold. And the reason is because we see that the same macro environment that is driving the natural resources supercycle is also driving a gold supercycle, but the reasons are very fundamentally different. Right, in the sense that, and Matt, you pointed this out to me the other day, that the rest of the resource sectors are being driven by a tightening of supply, which we talked about in our last conversation. But gold is different in that there isn't a supply issue; it's being driven by investment demand. Could you guys kind of like elaborate on the difference between those two and why investment demand versus tightening of supply is the issue here with gold?
Yeah, gold production, if you just look at major producers, is declining, just sort of generally. Like I have a chart up, on my screen. I just looked across, Agnico and Newmont and the other majors. And the chart's going down over a period of time by, call it 20% since 2008. So, as mines go, they tend to deplete reserves and mine the best areas first. And the industry just by and large really hasn't invested in replacement tonnage. Same as most of the other resource industries too, right? But the interesting thing about gold to me is like the ESG policies that we talked about with Mark Rossano last week that are driving the scarcity of fossil fuels and metals, which are leading to higher energy and materials costs, which ultimately that leads to slowing global growth. And what the net effect that has when growth starts to slow globally, investors tend to sort of shift their attention over to safe havens, right? And this is really where gold comes in. So, we do have a little bit of tightening of supply and a little bit of increase in cost on the mining side for sure with gold, but then also on top of that, you have these macroeconomic conditions that are set up to, I think drive, investment demand from, not just institutions, and retail investors, but also potentially central banks with the chaos that can cause in currency markets.
All right. And so, Cam, just before we keep going on this, just to really reiterate to everybody why it's so important that we wanted to get Cam on here. What do you know about gold? What the hell do you know about this sector? And why should anybody listen to you of all people when we talk about gold and its place in the markets and as a investment vehicle?
Well, first of all, my experience. I've been in the business for 32 years and really been a specialist in the metals and mining space since 2000. And, what really drew me into the precious metal arena was watching the stewardship of central banks and governments around the world perpetually, creating QE and debasing currencies. Going back to Matt's comment about the supply side, you look at the money supply increase in the last 20 years, and you look at gold supply increase, I think it's grown by about 2% per annum, whereas we've seen the printing presses globally continue to expand. And compounding that is we've seen an expansion of the debt levels. Most people don't realize that the global debt now is $300 trillion on a GDP level of $85 trillion. And so when you look at the stewardship of what's going on, the value proposition of gold as an asset class and as a currency is getting more and more prevalent. Most people don't know, for example, that gold is one of the top 3 reserve currencies in the world. You've got the US dollar, the euro, and gold. Eastern and central banks of the non-Western world see that because they're big buyers of it. And the Western world seems to be lost on that theme. They're more interested in cryptocurrencies and digital stock performance than hard asset values like precious metals.
Right. And what's the debt load on gold as that third reserve currency?
The debt level?
So it's kind of a joke.
Zero.
It's of those 3 reserve currencies, which one has debt and which one has?
Well, one of the things I say to clients all the time, and in fact, I was talking to a large client the other day who has a lot of US dollar holdings. And he asked me, he said, we've had this parabolic move in US dollars. Where should I deploy or redeploy some of my US dollar holdings? I said, well, I'm going to ask you that question. And he said, okay, well, what about the Canadian dollar? I said, well, the debt levels in Canada are much greater than the United States, and our currency is appreciating. We raise rates, our currency goes down. That should tell you something. You look at what happened in England last week. The Bank of England just intervened with 64 billion of QE in this environment because they had a liquidity crisis in their pensions. The euro, the euro is par with US dollar. The Japanese yen is a controlled currency by the Bank of Japan. And most people don't realize that the gold market's $150 billion trading value per day. And gold's the only currency in the world that has no political attachment, no debt obligation, and no printing press. So if you're very long US dollars, you're getting concerned about your dollar exposure. You should be considering some diversification, and really, what are your choices?
Right. So let's talk about this. Let's start with the sovereign debt issue that we have here, because I feel like, of the major factors that are at play here, we have this massive sovereign debt issue where this is potentially the first time that we're going to see a sovereign debt crisis in the core economy, not in like ancillary economies. So can you guys kind of like, what's the shape of this? Like for people who are, again, more generalists and may not understand like all the nuances of a debt crisis in general and what's happening right now, what's the shape of what's happening right now?
Matt, you want to go first?
No, you go ahead there. I'm pulling together two notes. So
okay, well, the sovereign debt crisis, everyone thinks it's third world nations that are going to have a sovereign debt problem. We're seeing it obviously in Sri Lanka, Turkey, but Turkey's inflation rate's 80%. The Turkish lira has been collapsing. They just lowered rates. Okay. So, those are the problem childs. And you go back to the debt Asian currency crisis of the past, there's a domino effect. And because our global banking system is so intertwined, there's systemic risks. I mean, right now, everyone's talking about Credit Suisse and what's going on there. You look at Deutsche Bank, what's going on there. But what people don't realize too is you have a lot of established economies. You've got Canada, you got the UK, you got Italy, Australia, Austria. The debt levels per capita are very, very high, Japan as well. And so it's not just the emerging markets, it's also the developed markets that have a debt problem. And so you have this fibrillation that's taking place. And I can't emphasize enough the problem last week in the Bank of England, interjecting $65 trillion into QEing because there was a liquidity problem in their pension plans. What people don't realize is these pension plans, they need a 7.75% annualized rate of return to meet future obligations. And so they've leveraged themselves on these instruments because money was free for such a long period of time. So you have this debt leverage system that is now starting to fibrillate. So you start looking at currencies and intertwined economies and financial systems. There's a lot of stuff that's unsettling right now. And that's one reason I think what the US dollar has gone parabolic here is because you've had this move into a rising rate, perceived, number one currency in the world.
And I'll tack on that the higher energy and materials costs that we've experienced, the US hasn't ostensibly experienced a serious bout of inflation since the 1970s. We had Volcker come in the 1980s and quash it down. We basically been on a glide path down to 2% ever since until COVID hit, right? Well, now, we've been exporting all of this inflation to other countries for years, vis-a-vis, we'll export all of our labor costs to China, so we can import cheaper goods and those sorts of things. And now, we're entering into this competition where, well, we want to reshore some manufacturing. Well, what's that going to do to our underlying labor costs? Well, they're going to increase. So we have to invest in automation. Well, that's a lot of, there's a lot of dollars that need to go into that too. So, the idea that prices are going to return to, where they were pre-COVID, I think is a fool's errand of a test to try to project at that point. I think we stick higher, and that means that, these inflationary pressures that we felt are sort of here to stay. And that's at its base level, that's what's been, driving interest rates, right? It hasn't been the Fed. The Fed's been behind the curve. The market has been raising interest rates for us for some period of time. And the difficulty with that is that we get into, a bit of a spiral as the dollar goes up. Cam mentioned, countries like Turkey who have a large amount of dollar denominated debt, for instance. So, as the dollar increases in value, it puts additional pressure on those countries to be able to settle that debt that's denominated in dollars. So they have to make, additional trades, which is, it's possible, let's face it, with resource prices where they are, but there's a lot of pressure to get that done. So, as the dollar continues to rise, eventually, at some point in time, I can't, necessarily predict when, but let's say that begins to cause defaults on sovereign debt. Well, what happens to that dollar demand? Well, it goes away. So dollar demand goes to zero. We talked a little bit about this with Mark last time. So the the path to, oddly, the path to the calling the dollar into question as a global reserve currency, it doesn't die going down, it dies going up, because all of that dollar demand, as countries default, would be reduced to zero. That's that. If that were to happen, that's really when you need to be invested in gold, because here over the past year or so, gold has developed this really nasty anti-correlation to the US dollar and to interest rates. So I'm of the mindset we don't quite get to that point, but rather we'll get to sort of a breaking point. We'll see a slowdown in global growth, and then deflation will start to kick in. Or alternately, we're just going to stagflate our way through the next 2 to 3 years. But traditionally, those are both macroeconomic circumstances under which gold in particular performs really well. That's when it does come in and do its job. And, I know I think we're down, 9-10% or whatever on the year in terms of pricing. But if you look at that relative to the market's down 25. I know the dollar has been the asset class to own over the course of its year, but at least relative to markets, gold's been doing its job too. And I suspect when that inflection does happen, I would suspect that to be sort of beginning of the year, middle of next year, somewhere around in there. We're going to see a really kind of market turnaround in gold prices at that time.
Just going back to that, most people don't realize, but in terms of the British pound, euro, yen, Turkish lira, gold is trading near its highest. And so, gold was $1,900 in April, and then all of a sudden the dollar took off. And going back to two things you were talking about the Volcker period, again, this is very important for people to understand. Everyone looks at the inflation fight that Volcker took on between 76 and 81 when he drove interest rates up. What's different this time is when Volcker embarked upon that, the debt level to GDP in the United States was 34%. Now the debt level is 150%. Okay. The other thing too is everyone talks about our interest rates right now are historically low interest rates. It's not about historically low. It's what the pattern has been for the last 10 years. People have got addicted to zero interest rates. And so if you look at the percentage move of interest rates in the last year, it is the biggest percentage move in the shortest period of time in American history. So think about the financial shuffling that's taking place. And so those are elements. And so you look at the dollar going up, and again, people keep on running to the dollar, and there's a shortage of dollars because what you've got these countries now that are getting under so much duress. They're trying to pay back their debt and pay their higher interest, so they have to buy dollars to do that, and that's adding to this move. So at some point here, this dollar is going to exhaust its exponential move, and then the question you have to ask yourself is what currencies do you want to buy at that time, given the financial stewardships that are going on. And that's where, again, the argument for gold is very compelling.
Yeah. So, I mean, just to kind of contextualize all this, then that's something that's been warned about for a long time for good reason. But now we're at these extreme levels of global debt in an environment where we have all kinds of on the start of the supply chain that is inflationary throughout the whole thing, that we have geopolitical instability. So you have potentially a changing kind of geopolitical world order with a kind of a changing interest rate environment with all these debt issues. And in this environment, the dollar is strengthening as it has been, is potentially going to cause all these other countries' currencies to default because they aren't going to not be able to service that debt. And so you have kind of like this stack up of things that are hitting all at once. That is like potentially the catalyst here is just the dollar continuing to go straight up. Do I have that right?
Yeah, and John, and that's one of the frustrations I think that in the precious metals market is that everyone's going, this is a perfect environment for gold's performance. And everyone's like, how come these things have been going down? And again, to emphasize, in other currencies, it's trading near highs. It's just dollar denominated. And one of the things and actually, Matt, you mentioned this too, is these algorithms. The algorithms are programmed that if interest rates are going up, dollars going up, gold inverse. And so these algos, and you can see it in the market activity every day, these computer programs are driving these moves. So fundamentally, it logically makes sense that gold should be getting a greater bid here, but it isn't because of these algos.
Now let's focus in on that issue of investor demand, because there's obviously there's a huge range, excuse me, of investor types. Excuse me. Sorry. But with the sovereign debt problem, like, it's the countries themselves, it's the central banks, right, that are buying up gold. Sorry. So, like, who is buying up all the gold right now? Who are building reserves? You talk about that gold is the third reserve currency. I mean, what's China doing? Like you said that before, they're the largest gold producer.
Well, just to answer that question, I spent a lot of time with the World Gold Council, and very active in helping them with their initiatives moving forward as well. Randy Smallwood, who's chair of the World Gold Council. So again, going back to physical demand, I mean, there's over 80 central banks in the world that continue to add gold. But again, they're not the Western banks. I mean, especially North America. They, like I mentioned before, they fall in love with the idea that crypto, Bitcoins are a replacement. And their argument is it's financial hedge, inflation hedge. Well, I'm sorry, but it's gone from 60,000 to 20,000. And just, if I could, do you want to go into some of the initiatives of the World Gold Council since I'm on this topic?
Yeah, go for it.
Yeah, I'm interested to hear what they're doing too. So we'd love to outline that if you would.
Okay, so first of all, I give a lot of kudos to Randy Smallwood. He's supposed to be stepping down as chair of the World Gold Council, but he's staying on an extra year because his initiatives that he wants to see through here. At the Denver Gold Forum this past, or 2 weeks ago, they had a panel, and it was called Gold 24/7. And most people don't know what World Gold Council has been working on, but the World Gold Council, LBMA, they collaborated about 8 months ago. And what's important to that is that it basically shows the authenticity of the source of the gold, which is the most important thing if you're going to do something in the crypto world with gold. And so that represents, over 2/3 of the world's gold production in that arena itself. So once you have that stable source of where the gold is coming from, the next move, and this is what they're working on right now with 2 pilot tests, is a blockchain crypto-backed gold. Now think about the significance of that. You've got someone, you can buy Bitcoin at $20,000, and you're buying something where, quite honestly, they haven't even interviewed the founder of Bitcoin. I mean, that's still shocking to me. But if you were given the opportunity to buy a crypto-backed gold crypto coin in today's environment, it opens up a whole new universe of buy side. And so when people start realizing that gold is a reserve currency, it's a very liquid instrument, and it is a protective asset. Case in point, it's only down 10% this year when most asset classes are down much, much more. It's going to open up a whole audience. So that's the initiative that's coming. It's called Gold 24/7. And I think, as I'm hearing it, next year, we will see the launch of this, which would be very material on the demand side.
Wow. Yeah.
Most people don't know this, though.
Yeah, I didn't realize that.
Yeah, there've been some talk about that. I remember talking with Rick. I mean, this is probably 2018, 2019, where those kinds of ideas were being discussed, but it's finally coming into fruition, it looks like.
But you know what, Matt? Back then it was being discussed, but the big issue was the authenticity of the source, right? So if you're buying a gold-backed crypto, how do you know it's backed by real physical 100% purity gold? That's why the LBMA and the World Gold Council collaboration is key, because now when it gets launched, it's 100% purely authentic and guaranteed. Okay.
Gotcha. So it's a certification process.
Certification process, exactly. Because otherwise, in this financial world where there's scandals left, right, and center, we're seeing it all over the place in cryptocurrencies. There's only one gold, and there's only one gold crypto, and it's 100% backed. And that's what makes this unique, because it's just one product, and you can't print it. It has no political attachment, and it has no debt obligation. And guess what? That's the argument that the coin people make these days.
Yeah, that's actually, Matt, let me bring in, because, man, we had a conversation yesterday about this difference in, like, because there's the idea that on the one hand, Bitcoin was started as a currency, but it acts like a commodity. And then a lot of people think of gold as a commodity, but it acts as a currency. So let's talk about this difference between what a commodity and a currency is, and then apply it to both of those assets.
Sure. The way that I kind of look at it is, I mean, Bitcoin as an asset class, I just kind of think of it as, in the same way that, oil or copper or, coal or natural gas, like those are physical things, right? Physical commodities. Bitcoin is sort of like digital stuff, right? It's the digital representation of value in this case, right? So the reason I think of it more of as a commodity than as a currency, which is, I don't know why. I guess they wanted to create an air of legitimacy around it, calling it a cryptocurrency instead of a crypto commodity. But it really comes down to volatility, right? Bitcoin can move up 10%, 15% in a day. A currency is by design should not be doing that. We can see 10% moves in coal or natural gas. I mean, natural gas was up, has been up or down, 5% here, I think each of the last 4 sessions.
Mhm.
That is not something that you want to see in a currency market. And this year we really haven't seen that too much amongst the major currencies, even though it's been a wildly volatile year for currency markets in general.
Mhm.
So if you flip flop and go ahead and look at gold, well, gold volatility is really comparatively low. And part of the reason for that is it's a very liquid market. There are a lot of different expressions for it. And then the if you think about it from a network perspective, that has a very wide network of participants, ranging from retail investors to institutional investors to even all the way up to central banks, as we were discussing earlier. And when you get global participation of that sort of level, your volatility profile is going to come way down. So gold, I think is like a factor of 2 to 3 in terms of volatility lower than Bitcoin. So I don't think Bitcoin is as unuseful as I think a lot of detractors have proclaimed. I certainly think the technology, the blockchain is here to stay to some degree. But to equate gold and Bitcoin, I think is really doing each individual asset class a disservice.
Yeah, I agree. I would just add to that though, if you look at correlations, if you look at Bitcoin, you correlate it with the NASDAQ. I'd say there's a greater correlation with that.
100%. It's a leading indicator of the NASDAQ usually.
Yeah. So it's more of a speculative instrument that people have turned into an asset class of currency. But again, you look at some of the moves, like I want to point out, like El Salvador, for example, the president, they bought $50 million worth of Bitcoin because they wanted to establish themselves as embracing Bitcoin. But behind the scenes, what you need to know is El Salvador is also a major center for money laundering for the cartels. And so what they're doing is basically saying, we're open for business. We're embracing this, so you can trade through your cryptos through us. So, but the perception is all of a sudden the fanfare in the media talks about how El Salvador is embracing Bitcoin. Well, you have to look behind the scenes as to what their objective was, right? Just this last week, a lot of discussion further about money laundering in Bitcoin, right? So anyway, that's my thoughts on that.
Awesome. So then to kind of go back to where we were prior to that, when we were talking about central banks buying, that kind of leads to, like, with the strength of the dollar, and there's this idea that there's a currency war happening, and that is going to increase. Can you kind of map that out, just big picture for us? Like, what is this, when we say currency war, what specifically do you mean?
Mm-hmm.
Like, what does that term mean? And how is that playing out here in real time around us?
Cam, did you want to take this? You want me to go ahead with it?
You can start first. I'll continue on. How's that sound? I know you were mentioning this before our interview, so I thought I'd let you run with it first.
Yeah, well, it's, I think, sort of what the Fed is having to do is, by raising interest rates and by staying hawkish, throughout this slowdown, really what they're saying is we're ambivalent about the pace of the dollar here at this point in time. Where that begins to turn around, I think, is when our allies begin to suffer as a result of it. And, I think, last week's debacle with the British pound was kind of the first such episode.
Mm-hmm.
And what I think is going to ultimately wind up happening, and Cam, you and I have talked about this, previously, is that it's going to basically allow the world to begin to take sides, sort of. We have this sort of self-sorting of countries into, autocracies versus democracies. And, the democracies, our allies are largely lining up behind the dollar because, if you have good relationships with the United States and you need access to dollars, you can either access them via a swap line, direct swap line with us, or alternately through the IMF, which is ultimately backstopped by the Fed. Whereas if you don't have a swap line, you're at the mercy of your own trade to go out into the world and to get those dollars. Mm-hmm. And obviously China has their own designs on trying to wrest some semblance of control away from the dollar to be able to conduct trade in the yuan to some degree. Obviously, after the sanctions on Russia and India have done some business, I believe, in rubles. Putin is asking for settlement for natural gas contracts in rubles. Mm-hmm. So those are the kind of first, shall we say, shots across the bow of, in the world of, where are we moving over the next decade in terms of dollar hegemony, I guess is probably the best way to put it. Does that make sense, Cam?
Makes complete sense. And again, I think one of the key points there is your comment about autocracy versus democracies. And, I know Biden's been using that more and more in his deliverance, but we're seeing a greater divide in what's happening. And, the autocracies, again, about 2 months ago, they were talking about creating their own G8. Okay. And going back to China, China's been, making very big, bold moves around the world for the last few years. And they started quietly, then they started getting much more brazen about it. Most people don't know, for example, 3 years ago, China did a deal with Iran. And in exchange for cheaper oil, they were doing foreign investment and military investment into Iran. Okay. And then some of the other moves, the Hong Kong martial law move in, that was supposed to be one country, two systems, and that's no longer. You look at Nigeria now transacts oil in Chinese yuan. 2 days after the US pulls out of Afghanistan, boom, who's in there? The Chinese. And so they're making much more bolder moves. The other thing too is that you look at the emerging markets, and you look at places like Sri Lanka and other emerging markets, who are the biggest financiers of their infrastructure projects? It's the Chinese. So the Chinese have basically built up these massive debt obligations from these countries towards Chinese with these infrastructures. So who's bestowed to China now? So these moves that are being made are a move by a government and a country that wants to, we all know is challenging and wants to, surpass the US. Now their infrastructure and their financial system is still, there's a lot of shadow banking systems in that, but the world is getting more and more aligned with them as the US continually, pushes these autocracies towards China. And, the Russia-China situation is, that's obvious. I mean, the Chinese are not, they could clamp down this whole thing and they're not. We know that, right?
Right. So for simpler minds like mine, the things that I'm hearing then are there's kind of two elements, two broad categories or buckets of this currency war aspect. And one is simply as all these other forces interact and create a stronger dollar, that creates real debt problems for people trying to service that debt. It creates all kinds of other issues. And then the other piece are things where autocratic countries, as they are coming together, are starting to very aggressively move away from the dollar as the reserve currency and trying to kind of unhitch themselves a little bit more from the US dollar. Is that how you describe it? Or
well, you're seeing that because of global trade issues too. But really, going back to Turkey, for example, I mean, they've got 80% inflation. And a lot of it has to do with the devaluation of the currency. Mm-hmm. And so they're sitting there with their debt denominated in US dollars. And I mean, this is not a comfortable situation for them to be in.
Right.
So going back to their perception and loyalty to a currency that's doing so much damage to them, that's the damage that also is taking place, right?
Right. So then that would be the thing that ties both of those other two things together, is that everyone's trying to manage their local economy. And if a strengthening dollar is starting to really damage that local economy, then just for the sake of, because we know, like the Arab Spring, we call it the Arab Spring, they call it the Peasants' Uprising or the Peasants' War, or the Wheat War. It has all kinds of impacts across a population. And so that autocracy versus democracy piece starts to look more like well, within different environments, they're trying to manage, how do I deal with everything else that's changing and before the ship goes off the edge of the world?
What I think it does is it prompts the idea of maybe a dual system rather than just a one system, right? And there's been talk about that in the past. And again, and who knows what's at work here, but we all know China's the largest gold producer in the world. So none of the gold leaves their country, and they're net importers. And last month alone, big imports out through Hong Kong and through Singapore into China. We know Russia and their stance on gold too. So you start looking at these countries who perpetually are adding to their gold positions. You got to be asking yourself, what is their objective here?
Right.
Yeah, and I'd add in on that. Russia in particular, going all the way back to the Crimean invasion. When we threatened to cut them off from the SWIFT system, they began to amass gold reserves, and actually amass gold reserves in excess of their dollar-denominated debt, in order to back up the rubles. So there's at least one example of how gold is basically prevented Russia's currency from completely collapsing. I mean, we attacked it incredibly hard at the beginning of the year, and since then it's regained a significant portion, if not all of its value. I haven't looked it up recently.
Well,
go ahead. Sorry.
No, and that's I think the wording that's best to describe that is the U.S. has weaponized the dollar, right? And so and again, last week when Russia annexed the four regions of the Ukraine, a lot more, actually last Friday, most people didn't pick up on this, but one of the comments from the U.S. administration was that countries dealing with Russia in terms of supplying them, armaments, etc., could face consequences. So what they're saying is that if you're China, if you're Iran, you're other countries, and you're actually, for example, we all know India and China and Saudi Arabia are all importing oil. Okay, so which is aiding and abetting the war movement. So, but the comment from the U.S. was that there could be consequences of dealing with Russia. So if you're China, or if you're Iran, or Saudi Arabia, or whoever, and you're holding your U.S. dollar holdings, is there a suggestion there that they could weaponize your dollar holdings against you? And again, there's another reason why I think the demand that is continued on those parts of the world for gold continuing. And yet in North America, most people have no idea what's taking place.
No, that's fair. And then that the other wrinkle I think that with China that we have to sort of realize is yep, they're the largest gold producer in the world. And then I actually pulled up the import tables that you were talking about before we started the call. And I mean, it's like a 4x increase in gold imports through Hong Kong or something like that, just over the past two periods. China has an enormous amount of dollar-denominated debt too. But what sort of sits beneath the surface in their off-balance sheet liabilities is that pretty much any debt that China takes on, be that from a sovereign perspective or from a state-owned enterprise or corporate perspective, loans that they give to personal businesses, and then personal debt itself. I mean, credit card debt in China is off the chart. All of that is ultimately backed up by the PBOC. And if you think about in terms of do they have enough gold reserves to actually physically back up that totality of it, the largest country in the world with the largest personal debt levels in the world on an aggregate basis, do they have enough gold to do that? My suspicion is no on that totality point, but from the sovereign side, they're probably okay. That's also, I think, sort of working in the background and is pressure on the minds, I think, of Chinese officials.
Well, again, going back to reserve currencies, U.S. being the biggest gold holding reserve currencies, but China is going to build that up because in order to have eventually an emerging currency that's a global currency, you have to have a reserve base. And don't misunderstand me. I mean, China's building this out. I mean, China has all of its problems too. The shadow banking system is, who knows what's going on there. We've seen the Evergrande, the real estate market problems, and so they have a lot of problems too. No question about it. What I'm saying though is that if you look at currencies in the world and stewardships of the world, gold is the only currency in the world that has no political attachment, no debt obligation, and no printing press. So as a central banker, you can own that because nobody can weaponize that. And it's something that's going to stand the test of fiat currency volatility, which again, that, as Matt was saying, we're going to these devaluation currency wars. The stress test in the currency world is going to get greater and greater by the looks of it, and therefore the argument for gold is getting greater and greater. It's just not a theme that's looked at in the Western world, especially United States right now, because US dollar is reigning supreme.
Right. And in that, autocratic kind of side of the world, then if you say that there's functionally right now 3 reserve currencies, and 2 of them are Western democratic currencies, the euro and the dollar, and then the third one is gold, then it makes sense that whatever kind of transition you're trying to manage, you're going to be going to gold, because the other 2 are, even if the euro isn't weaponized, that's a potential threat down the road from a strategic standpoint.
Right.
It would seem to make a lot of sense that would be why they would be loading up on gold.
Absolutely.
And so let's take this from like that macro kind of picture now to kind of like, well, what the heck do I do as an investor? Like, what are potential catalysts here for gold? And then what is the case for the various ways you can invest in gold, right? Because you can go, there's physical, there's ETFs, there's miners, there's explorers. Like, can we kind of walk through kind of what are the potential catalysts here? And then what's the investing case for some of the different types of assets that you can invest in?
Yeah, from a catalyst perspective, why don't I handle that beginning, and then we'll pass it over to Cam to take it through kind of the investment outlook and sort of handle it like that. So, the catalyst really is anything that's going to spark investor or central bank activity in the metal itself. When I think back a few years to there was a flash crash in precious metals markets where we saw over in the overnight. Somebody fat fingered an order, and gold went down by, I forget how much it was, like 5 or 10%. But I remember writing at the time that the thing that struck me about that wasn't that it happened, because mistakes like that happen from time to time. When in the normal course of human events, it's that all of that gold and silver got sucked up. Literally, there were enough limit orders at those support levels to just hoover it up, and I suspect those are, central banks or large institutions that have those limit orders out there. But what it showed me at that point in time, and this has been years ago, that that gold was on people's minds, and that it at a certain value level, it is always a part of either an investment strategy or a sovereign tactic to backstop your currency going forward. So there are, what could the catalyst be this time around? Well, I mean, usually it's either some sort of supply demand imbalance, right? So, if we have a major supply outage or something like that, that could spark some interest. But what I figure is going to happen is it's going to be geopolitical in origin this time. Here we are just a week removed, just a few days removed really from Putin actually threatening to use nuclear weapons on Ukraine. From my perspective, that looks more like brinksmanship, to maybe stop the advance of Ukrainian troops on those last 2 oblasts. Mark Rossano and I talked a little bit about that very thing the other day. But any kind of additional tension that builds up in that conflict could be one that sparks a flight to safety or a fear trade. And typically, like when we go back and look over, these really wild moves in gold over the past few years, it kind of starts with a fear trade, right? Where people are looking to flight to safety, either to back up their currency, to sort of ensure their portfolio against additional volatility in markets. But then Cam alluded to algorithm trading earlier. Well, when that fear trade turns into, say, 3-week, 1-month momentum, that's really when algorithms will actually start to kick in. So the fear trade can turn into a momentum trade. And then when you get momentum buyers chasing that, that's when you can get, a real kind of blow off top in gold markets. And we saw that post-COVID, right? Mm-hmm. We had the initial crash in March, and then the kind of fear and global uncertainty, geopolitical uncertainty that surrounded the virus, began to see a lot of money poured into it. And then algorithms kicked in, and then retail kicked in. We saw, gold go up to, 2,100 before, the bazooka of monetary relief that the Fed put into the market began to actually reinflate the bubble and ease off pressure on the gold market. So, you know, we're entering into this period of really complex sort of geopolitical behavior, and my track record of predicting that is, you know, unblemished by success. So it's hard for me to exactly say how, you know, what catalyst is going to start, you know, this next phase. But I think it, you know, would behoove us to not pay attention to the fact that tension is growing in the world and not shrinking.
Mm-hmm.
And, you know, there are enough factors in China, Russia, Ukraine, in Iran, you know, across the Middle East, and even here in the United States to some degree itself, that could, and Europe, that could start the next bull run.
Yeah, just to go on that, just yeah, the geopolitical arena has changed, and which again changes the global supply chain, which again will keep upward pressure on inflation. And there's no question. I mean, again, let's just go on one little note here: the Nord Stream 2 takeout. And there's no question that was taken out. And I'm not sure if you've seen, but if you go back and you look at an interview with Joe Biden prior to the invasion of the Ukraine, the question of Nord Stream 2 came up by a reporter. And Joe Biden says that if Russia enters Ukraine with tanks or troops, there will no longer be a Nord Stream 2. And then the interviewer said, well, how can you say that? Because, you know, it's controlled by Germany, owned by Germany. Biden bowed his head, looked at the camera, and just said, like I said, there will no longer be a Nord Stream 2. And so that happens. And then again, this is the geopolitical arena that's changing. Yesterday, OPEC met, and they cut production by 2 million barrels. Okay, look at the duress in the world right now, and they cut production by 2 million barrels. And don't forget, Biden went to Saudi Arabia about a month and a half ago, 2 months ago, and one of the things he was lobbying was increasing production to help American relief because they're going to midterms. What people don't realize is the week after he went through there, guess who went through? President Xi. So you start looking at what's going on. I mean, OPEC is controlled more by autocracies, and they cut oil production by 2 million barrels at a time when the Western world needs relief. So going back to the geopolitical tensions and that's not going away anytime soon. The narrative right now, just on the financial side on gold, is that, you know, the Fed pivot. That's what everyone talks about. When the Fed pivots or pauses on the interest rates, that's when the dollar is going to roll, and that's when gold is going to take off. And what I find interesting right now is that we haven't seen any pivot. We haven't seen any narrative. They keep on talking about wanting to raise rates on their 75 beeps next meeting. But you're starting to see the gold stocks trading differently, the senior gold stocks. And they're typically a lead indicator, because if you're going to go for the leverage move on the gold trade, the equities are where you go. And so we're starting to see different trading patterns, and whether it's a pivot or a pause or international pressure from emerging markets, and that you know, we can't have a break somewhere in the financial system, because that'll come back in the financial world in I mean, Credit Suisse, Deutsche Bank, HSBC right now. Canadian banks, a lot of the Canadian banks are down 30-40%. There's a lot of financial things that are going on right now. So this dollar is wreaking havoc. So is there going to be pressure on them to pivot or go pause despite inflation pressures? So that's the narrative that people are driving. I mean, all the narrative geopolitically and militarily, all that is there, and all the reason in the world. And that's what's so frustrating to the gold investors today, is that we should be a lot higher right now, but we're not, because the dollar exponentialized in this environment.
And so the question sort of then becomes, well, you know, it's not if they're going to pivot, when. Right. I'm of the mind that I don't think they can really do it anytime soon. Interest rates are where they are. We know they still have, you know, at least 2 more 75 basis point hikes, you know, I think planned through the next 2 quarters. So, you know, at what point in time do they actually begin to pull back? I think the metric that they're looking at right now is unemployment. You know, and the unemployment numbers, at least, you know, on the surface have been reasonably, you know, positive, right? And we have this huge labor shortage. You know, in the oil patch, we can't find in labor. We can't find for rail. We can't find labor at coal mines. You know, all these industries that I cover on a day-to-day basis. And you know, if you're the Fed, and that's become your new mandate, is to basically protect, you know, employment or break employment. If that's your indicator, then they're not, I don't think they're going to stop here anytime soon. That's kind of why I'm looking at, you know, beginning of Q1, kind of to the middle of Q1, when we get full on into winter, when we run the chance of, inflation, reaccelerating as energy prices rise, I think, that's a point in time where you could see additional pressure on them. But right now, the narrative, they've said exactly what they're going to do. They haven't deviated from that script yet. And I think there was even the word pain that worked its way into Powell's testimony, the last time he made an appearance. It's kind of an uncomfortable word to hear a central banker say, to be frank. So, I don't know exactly what their metrics are to looking for that, but I suspect it has to do with the labor force. We did see yesterday Jolt's job openings. Not that I put a whole lot of faith in that particular metric, but they came down by, a pretty significant amount. A lot of those jobs have just sat there open for a long time. They haven't been filled. And I think people are just finally pulling them off the table. That work has been redistributed, productivity kind of is what it is. But if I had to speculate as to when we'd see, a turnaround in that metric, I'd be looking for post-Christmas. Like, I think, most companies are going to ride out, this wave of inflation through the end of the year. And if financial conditions don't improve by that point in time, I would expect to see, a round of layoffs begin probably starting January 1. That's just my perspective.
We're already seeing a lot of layoffs. I mean, in terms of tech line, you're seeing across the board 10%, it seems. And the financial world, you're seeing layoffs in Wall Street in that. But one of the things in the labor front that people have to take into consideration is, COVID comes along. A lot of people took early retirement. People that are 63, 64, they just said, I'm out. So they're out of the labor pool. The other thing that was talked about, and it's been, the bell curve of the population, and look at the declining age of the population. And so you have a whole declining age that is leaving the workforce. And so, that's an element that's going to be persistent for a long period of time. And so the biggest fear the Fed has right now, and Matt, I agree with you, the Fed, I don't think is going to give up to there's more pain, because I think they have to push towards a recession here, because if labor inflation gets entrenched, then you have velocity of inflation. And then people think prices continue to go up. It's expectations of inflation. But the labor inflation is one of the key components here. If that gets entrenched, now you've got, as I say, it's like toothpaste coming out of the toothpaste container. Try to put it back in. And so that's what I think they're most fearful of right now. And again, if they get in that situation, then they got to raise rates more. And again, going back to Volcker's strategy, well, we're no longer 34% of GDP of debt. We're 150%. And the pain of higher interest rates and inflation will become much more extreme. And that's their biggest fear. So they almost have to force a recession. And again, I just want to go back to the Fed. I mean, everyone's talking about the Fed's central banks around the world. Well, they did screw up last year. And let's face it, I mean, the track record of the Fed, Yellen was saying, inflation's transitory. But the biggest thing was they put $4.7 trillion in the system for COVID. I understood why they had to do that. But what you created was asset appreciation from all this free money and zero interest rates. And the asset appreciation created the wealth effect that created the consumption function. And, you had concentration of consumption function. You had durable good consumption function during COVID because everyone stayed home. Everyone bought new Apple products. Everyone bought restoration hardware. So it was a massive concentration that exponentialized the values of those assets, those underlying companies. Then we had the coming out trade, and then we had the travel and hotels, hospitality, restaurants. So it's been misleading in a lot of ways about how strong it is. What it's been is just directing a flow of water down different channels that are concentrated. And so I think this asset bubble that they've created is one of the major culprits that's unfolding here. And as the asset depreciate with a heavier debt burden, it's more expensive, that weighs on the asset values. And that's the process I think we're in right now. And that's why you're seeing some serious destruction in some equities.
So what do you do?
Well, that goes back to the gold trade. Again, it's been a painful one since April, since the US dollar took off. But if, as I say, if you're looking down the world today and you had to invest in a basket of currencies, looking at the political stewardship and the monetary stewardship of these major financial centers, you got the US, you got the euro, you got the British pound, you got the yen, and you look at those currencies, you can't tell me you wouldn't look at gold as a basket. And right now, I mean, the weighting in gold is so small. It's like, I think the fund weighting in the United States is 0.1%. And again, another fact people don't know, but effective January 1st of this year, Mercer Group, who's an advisor to $15 trillion of global assets, who traditionally has been a 60-40 bond equity balance, through charter change in their committee, came out with a 5% weighting in precious metals. And for multiple reasons, one of which, the primary reason, is they view a stagflation recession risk. So if they're suggesting a weighting of 5% and the weighting is 0.1%, you know, all you have to do is go to 0.5% and how material that is. And then you take into the equities, the gold equities. Well, most people don't know this either, but the entire global gold equity value is $300 billion, which is less than the market cap of Home Depot. So if you get any movement into the equities, you know, when people start realizing that 60-40 model is no longer working, then the value proposition in this space is so compelling, so compelling. And on top of that, the companies themselves, the senior gold companies, are paying you 4 or 5% dividend yields right now. Most of them are debt free. They've never been in better financial shape. A number of the companies are trading 7-8 times PE multiples. And nobody's paying attention because everyone's still trying to figure out Bitcoin's a great buy at 20,000.
Fair enough. Then I think, like, unless Matt, do you have anything? You're about to say something before I keep going.
Yeah, I mean, you know, let's think about the value proposition of gold and the miners here. Like, you know, I've been a mining analyst for a long time. I've specialized on the cost side. I mean, I do think we have kind of one more sort of inflationary push through to the cost of goods sold side, right? And I think we'll start to see companies here as we approach, you know, Q3 earnings, you know, begin to talk about that. I think you'll see, you know, people adjust guidance for costs here. And this is kind of like the last movement of cost push inflation before, you know, we should begin to see a decline, particularly in fuel costs, right? You know, we're coming off of a period where, you know, oil prices were $120. Now we're back down into the, you know, I think with the OPEC cuts, that kind of pulls the market back into balance with regard to, you know, SPR releases. SPR is going to stop being released here, you know, at some point in time over the next few months. So I think, you know, basically from the 75 level up to around 95, that's kind of the range that we're going to see oil trade in. I think we'll see gasoline sort of settle in there. Diesel is going to be higher, but I think mining costs are going to stabilize basically in this range. And what that means is we're going to get a new set of comps as we head into next year that I think will begin to be favorable for the miners. So, you know, maybe it takes a couple of months to play out or something like that. But I like, you know, Cam's comment about how if you're looking for leverage to gold in the longer term, obviously the miners can provide that. You know, I remember doing a study a long time ago. It was like, you know, I think Newmont and, you know, Agnico Eagle and most of the majors do a really good job of capturing the beta of any move in gold just in general. So it's a pretty easy, you know, straightforward way to play that. But I pulled up a gold chart to look at where prices are now. You know, we're hovering around 1,700 level, and even just a week ago we were down closer to 1,600. And I was just looking for a scenario where, well, what if you know we have another rip in the dollar, and you know gold actually breaches that $1,600 level. And I look back to, you know, sort of mid to late 2019, and there's this range of basically between $1,450 to, I'll call it $1,550 that gold traded in top to bottom. And there's clearly a support line for that because that's exactly where, you know, during COVID, that was that same bottom that hit right at that time. So if I'm thinking about downside for gold, the maximum downside from here is like maybe 15%. In an absolute worst case scenario. I don't think we're going to get there. So, you know, my suspicion is that, you know, we kind of have a kind of, you know, maybe adjustment period of time here during the start of Q4. But this is I would expect gold prices to consolidate around recent levels here. I would expect, you know, mining equity prices to consolidate around recent levels here and get ready for what I think is going to be a pretty excellent opportunity in 2023 to own both the metal and these equities, I think, going forward. that's kind of how I'm looking at it. And so now is the point in time where you want to begin preparing for that, right? Now is the point in time where you want to be looking at price action.
Well, Matt, just on that note, again, I'm Curry Metals and Mining Group, but I'm an integral part of our CANACCORD GENUITY mining team. So I talk to my analysts and bankers on a regular basis, and our senior gold analysts valuation matrix right now in terms of the senior producers are discounting $1,500 gold. If you look at their value matrix, right? So I think these stocks have already capitulated. Now, there may be another 5-10% to the downside, tax loss selling, realignments going to year end. Who knows what's going to happen? These markets, as we know with these algorithms, things can swing in ways that we don't expect. Like I said, since April, I would never have thought the gold trade would have come off like it did, but I would never have thought, and I think if you ask most financial people, who would have thought the US dollar would have gone to par with the British pound and the euro? I mean, it's just, these moves have been unprecedented. So going back to the gold side of things, I mean, if you can buy a senior gold company right now with a 4 or 5% dividend yield, and they're trading, near their lows, and they're in great financial shape. I mean, picking the bottom is not the easiest thing to do. Sorry, I just got to get rid of this. But we know we're close to that. On the gold side too, just to go back to the seniors and the mid tiers and talking about, Matt, you were mentioning about the supply side of things. One of the part of the sector that's most compelling in value are the developers. And last cycle we were involved with 7 companies that were taken over. And when you look at scarcity of assets, most people don't know this either, but from first drill hole, once you have a discovery, to take it through to actual production, the average timeline is 18 years. Okay, so you look at companies like Newmont and Barrick, they're producing about 5 million ounces a year. A lot of these guys have flat production curves. So they have to replace 5 million ounces a year. And the big boys aren't explorers. And so it's the developing assets. And there's very, very few assets that are meaningful in size that could tick the box for a mid-tier or a senior. And the scarcity of these assets, I mean, I travel all over the world with my team looking at projects. And I can tell you right now that supply side, when the market turns and realizes what's going on, it's going to be shocking in terms of the lack of assets that are available to investors. And especially given jurisdictional risks, I mean, you've got to know where to go, because something may look great in the country, but as a good friend of mine said, he says, what's below the ground is one thing, is what's above the ground is something else. If you don't understand the geopolitical risks of some of these jurisdictions, you've got to know how to invest in precious metal stocks. And again, that's how I've gained a reputation as a specialist, because I have my team and I have all these relationships. I've got over 40 clients who are principals and mining engineers. And so we have a great intel on the opportunities in the space. And there's just not a lot coming down the pipeline.
Yeah, and I'll put a link below this video for everyone who wants to reach out or connect with you on that too.
Okay, thank you. Yeah, but it's going back to when the gold market does turn and the value proposition of the seniors comes into play, and the weighting proposition of Mercer starts. When Ray Dalio came out the other day, 10% weighting in gold. He emphasized that they're the largest hedge fund in the world, and so all this is taking place, and yet the weighting is nothing in terms of equities. But again, picture this moving forward. All of a sudden, Newmont starts performing in a rising gold environment. Now the pressure from shareholders saying, well, you're producing 5 million ounces a year. What are you doing for growth? Now you got to start making acquisitions, right? Mm-hmm. And the one thing about mining companies, they have to acquire assets to replace ounces. They also have to acquire assets to grow. So if you're looking for the real leverage in the sector, where do you go? Go to the asset classes that will be acquired. And that's one of the real specialties that I focus on. And like I said, last cycle, we sold 7 companies to mid-tiers and seniors.
And interestingly, that kind of brings us full circle back up to, how we kicked off this conversation, right? Is that, the under investment in exploration and, replacement tons over the past decade has left literally the entire resource industry short on molecules going forward. It's prevalent in fossil fuels, it's prevalent in base metals, it's prevalent in battery metals, and it's even, as you point out, it's prevalent in precious metals as well, right? If you don't replace, if you don't replace those tons of ore, as you deplete your reserve, your production is destined to go down. And if
Mm-hmm.
we're entering into, as we discussed, like a period where there's going to be more demand for gold, not less, like this is where like that I think really sort of sits as a crux of an issue. And I mean, I'd love to sit down and talk exploration and talk, acquisition of mid-tier assets. But my suspicion is that's probably several 1-hour conversations as opposed to,
No question.
as opposed to just tacking on, a few comments here.
Yeah. All right. Well, I think we covered quite a bit of ground here, and we're coming up on our time. So Cam, like, I really appreciate you taking the time to sit here and talk to us about this, because this has been super helpful for everybody who, like I said, I'll put a link to Curry Mining Metals underneath this video. But with that, thank you very much. And thank you, Matt, for doing this too. I really appreciate it.
All right. Thanks, John.
John, Matt, thank you so much. Really good. Appreciate the opportunity to talk to you guys.
Sounds good.
Take care.
Thank you.